Now we're on to corporations, talking about them, share capital, the balance sheet, how this all works together. And I have a good look at that in the next couple of PowerPoint slides. So having a look at that then, we know that corporations are the most popular business structure in Canada. You see them every day. They have a name that ends in limited or LTD, corporation or corp, incorporated or inc, and it's got to be on the end. That's how you know it's a corporation. They can be publicly or privately owned. Publicly just means that it's listed on a stock exchange somewhere. Anybody can go and buy those shares as long as they've got a broker that's helping them with it. Privately owned just means that it's owned by just a group of people specifically. It could be that 4 or 5 people get together and start a company, and only those 4 or 5 people own that company. So quite a bit of difference in there in terms of what you can do. They're different than partnerships. Corporations are different than partnerships and proprietorships in how they account for ownership. But other than that, they look very similar. The asset side, the liability side can look very similar in a corporation to a partnership or a proprietorship. But when we look at the shareholders' equity section, that will often differ from the partner's capital or proprietor's capital on a balance sheet. Now, a corporation in and of itself is a separate legal entity. I've heard the term artificial person. Yeah, it's separate and apart from the individuals that own it. It goes and does whatever it does. The owners are owners, sort of thing, but they're not contingent or part of everyday management or everyday transactions. In fact, you can own some shares, have a shareholder own some shares, they can pass away, and the company still keeps on going. The shares then just become part of the estate and are transferred to someone else or are sold or whatever. And so we have this continuous life that happens with a corporation and the ability to transfer ownership fairly easily. There's no mutual agency, so this is in contrast to a partnership where we saw a partner could bind a business to do something. In this case, a shareholder cannot make a corporation do something. They don't have that power. Shareholders, in this case, enjoy limited liability. Limited liability in that whatever they've put into the share capital or into the business, that's all they can lose, generally speaking. In a partnership, if something goes wrong, we've talked about that, you can lose your house. You can have some really big problems. Here, there's limited liability, which is very attractive to a lot of people. And as I said before, there is this separation of ownership and management. There's the shareholders elect a board of directors who direct management or corporate officers to operate the business. But there's a distinction between who owns this company and the people that are managing it for the owners. Now, there's differences here too in that a corporation that has profit will pay tax on whatever their earnings are. But if those earnings are distributed to the owners, then the owners get a tax credit that's very similar to the amount of tax that's been paid on the income by the corporation. So corporations pay tax. We saw in partnerships how individual partners pay tax on their share of the income once they report it on their personal tax return. But corporations file corporate tax returns. And there's plenty of government regulation around corporation. It doesn't matter if it's, we'll get into stock exchanges or annual returns, that sort of thing, but there's lots of government regulation around this just to protect all those people that deal with corporations. And there are some very unique costs with a corporation, whether it's the issuance of share capital, reporting to shareholders. Often this is a significant cost, and you don't see that in partnerships or proprietorships. Now, There are many advantages and disadvantages to corporations, but let's have a look at a couple of these right out of the text. Often a corporation can raise more money than a proprietorship or partnership just because it has the ability to appeal to a larger group of people. It continues even if shareholder passes away. Again, transferring ownership, very easy on a stock exchange or something like that, but relatively easy to do. Even if it's a privately held company where we've got 3 or 4 people, transferring ownership can be done by a lawyer, and it's not that tough to do. Again, there's no mutual agency amongst the shareholders, and the shareholders have limited liability. So very important advantages there. A limited liability for sure makes sense if we've got a company that does risky stuff like maybe drilling in the oil field. Well, I don't know if I was a shareholder in that company, I don't want to have the liability just in case something goes wrong. So yeah, partnerships don't often work in those cases. That's where we have a limited company instead. Now, there are disadvantages in that there is a break or a difference between ownership and management, especially in public companies. Corporate earnings are subject to some double tax. Yeah, there are instances where that happens, but it's fairly rare. The government regulation can be expensive, or the costs of reporting or the cost of maintaining the company can be more expensive. And corporations incur costs unique to corporations, and that can include things like, again, annual returns or corporate tax filings, that sort of stuff that you don't see in the background. And we'll often see that the board of directors needs some sort of insurance against lawsuits, so that directors are protected from some sort of a claim by in a lawsuit. We see it sometimes happens. Again, an oil field company is a great example. Drilling company does something and things go wrong. The board of directors has made some bad decisions. Well, they need some insurance to protect them against that, and often that exists. Now, a corporation itself is organized or set up with something called articles of incorporation and bylaws. Think of these as like the rules of the game that a corporation is going to operate with. It gives it structure, and it talks about things like what kind of shares can be issued. And that could be, we're going to talk about common and preferred shares here soon, but it gives some structure to what the business is about, often more structure than we see in partnerships and proprietorships. The corporation, the control of the corporation is actually with the shareholders. They control the corporation, and it's the shareholders who elect the board of directors to set policy and appoint the chairman, the president, and others in the corporation. So think about shareholders electing the board appoints a chairman and also appoints the people who are going to run the company, and then sets the policies. Now here's a typical structure. This is a good one here. Just in terms of, we have many shareholders who elect a board of directors, and there's one person that's appointed the chairperson. The chairperson hires, or the board of directors hires, the president, or sometimes called the CEO or chief executive officer, who then appoints vice presidents in these various areas. And so there's a real delineation right here in between the board of directors and sort of the operations. So yeah, this is a great example of how you can have that sort of thing. Now, companies issue share capital or simply shares in a corporation to the shareholders. So it's very simple. If you want to own part of a big company, say you want to own part of, I don't know, pick your company. Encana, for example. If you want to own shares in Encana, you could, or Cenovus, that's a better one. Cenovus, that's an oil company. If you want to own shares in it, you could, and the company could issue shares to you, or you could buy them on the open market, which again, we're going to talk about shortly. The shares, they say who owns this part of the company, who controls it. it's got all sorts of characteristics and options in terms of how profits are distributed. We're going to get into that in more detail. So hang tight. Hopefully you enjoyed learning a little bit about corporations.